Welcome to S24's Money Watch.
Good evening, Yoel.
Now, remember, the economic report by Rand Merchant Bank, dubbed Zambia's Economy 2020 and Beyond, has some interesting forecasts, such as the Kwacha hitting the 28 mark and the economy only showing growth in 2023. I know we seem to be in the doldrums right now as a country, but don't you think these forecasts are a bit extreme?
Well, I'm not one of those who shares the view that it's a bit extreme, unfortunately, because there are two reasons why. One of the things is I've seen Zambia's decline that we've been heading to has actually been a decline that we were going into already. This wasn't a coronavirus only decline. And I think those earnings report numbers that we actually gave a couple of days back should actually give that kind of information to everyone, that you have to try and understand that there's been a lot of business as usual, effectively, even on the bigger side of the economy. So saying that Zambia was already slipping into a decline and into a potential recession was already on the books already. And then the other thing that we also have to take into consideration is that the coronavirus has actually done something around the world. It's accelerated, it's brought the future to today. And you're seeing this in all sorts of countries. Digitization has accelerated. China turning into a service-driven economy has accelerated. And unfortunately, Zambia's default, which a lot of the bondholders were saying was probably only going to happen in 2021, 2022, has been forwarded to a potential point of it happening now. So what we have to come and accept is that the future has come early and the coronavirus has caused this. So on the growth prospects, I'm actually inclined to think that we were heading into a recession, if not a depression, because we were actually seeing a lot of the trends that we were seeing from the 80s. We were seeing a lot of the trends that we were seeing from the 80s already building up. The other part I would take into consideration is even the Kwacha. You will take into consideration that it took us 10 years to go from about 2.5 to 5. Then it took us about 6 to 7 years to go from 5 to 10. And then it's taken us just 3 years to go from 10 to 20. By that trajectory, we're seeing, just by that trajectory alone, not to say that's the prediction, but just by that trajectory, you're looking at 40 in 1.5 years' time. That's the reality. What the pace at which the Kwacha is doubling is getting faster and faster and faster. And we're just waiting for it to finally hit that point. But this is what happened also in the 80s. It took off and just never stopped running. So that's what we're really worried about right now.
Right now, the latest update on the targeted medium-term refinancing facility, Munyumba, shows that as of 24th September, only 18% of the 10 billion Kwacha has been disbursed to applicants through their respective banks, of course. Then it further shows that of the 1.8 billion Kwachas disbursed to 18,000 applicants, 85% of that has gone to 250 companies. 250 is a meager 1%, Munyumba. What can you say about these stats?
Well, it speaks to something that a lot of us who are advocates for free markets don't want to admit and we don't want to say. And it's a reality we all don't want to face. Big banking is socialism for the rich, and more this keeps proving it. And this is one of the fears that we keep seeing from the coronavirus itself. I go back to what I was pointing about, the Lusa earnings report, seeing that over 60% of companies were still profitable. Some of them were still showing revenue growth. That tells me that big business is surviving while small business is suffering. And this is the first problem I have. Big banks, by structure, favor big business. And they favor and support big business. And this is how you get a situation where 1% of the money ends up going to 85% of the money ends up going to 1% of the applicants. And this is because banks favor bigness by nature of their credit ratings and their credit processes. And I know everyone will say, oh, that's just the nature of things, but that's the problem. That's a structural problem in banking that purports inequality, and it supports inequality. So that's the first problem, because this kind of facility was meant to ease banking processes, to actually allow money to flow to the smaller sectors who need it, because small businesses don't even have 30 days of cash, while most big businesses have got at least 2 to 12 months these days of cash. Even the same listed companies, some of them even have 2 years worth of cash and cash equivalents sitting in their kiddie pool. So they don't really need this as much as the small businesses need this. So the worry I think we're actually facing right now is that because banking is skewed towards, if you're bigger, you got more access to credit, you got access to cheaper credit, you're getting favored and favored some more. And this is a huge problem I'm seeing in the banking sector.
Yeah, no, but wouldn't the banks argue with you that it's per application, and companies obviously have different credit ratings, and they have processes that they follow to give credit. And I think you and I know that most small businesses most cases don't qualify for that much credit as compared to the big companies. Now, wouldn't the banks argue with you to say, we are giving those that satisfy our requirements?
Well, that's the purpose of having a government-backed facility, is to ease up some of these requirements so that you can get money to flow down into the areas that need it. And that's what I'm saying. This is the problem. Even with this kind of facility, and Yoella, we're not the only country that's faced this problem, but even with government-backed facilities, it's not trickling down to the smaller businesses. It's simply, this is a problem America has faced when they did it with their paycheck protection loans. This is a problem that was faced even in South Africa with the same loan scheme that was going out there. This is a problem when your banking sector is too big, it doesn't serve. And the other problem, Yoella, I'd like to point out, is because banking has been consolidated to these top 18 banks. We haven't diversified the pool. We've allowed big banks to take little banks. If I'm going to quote Offset from the Migos, we've allowed big banks to take a chomp out of little banks and take on this situation. We haven't allowed credit unions to thrive. We haven't allowed small community banks to thrive. We haven't allowed anything. We've been blocking everyone from the system. 500 credit unions have been basically iced out, and the Bank of Zambia keeps writing letters to tell you that they're not even interested in the village banking system to bring it on board so that you can get more capital flowing to the smaller parts of the economy. This is still a problem. There's too much credit and capital flowing through the big banks, and that is causing inequality. That is a structural problem. You need to open up the banking market, widen it out so that you can get different diverse kinds of banks who can serve the smaller parts of the community. Because like I said, a big bank will favor big customers. That is always going to be a problem, and we need to push this down very quickly.
Munyumba, finally, what have been the highlights in today's markets, and what is your forecast for tomorrow?
Well, looking into today, the markets obviously have continued their same trickle down as we've been pointing out. And that's because, as we said, the big concern that happened yesterday, actually going into today, was that the 10-day moving average moved into 20. That means that's the consensus baseline now of the sell rate that's now moved into 20, and it's staying above the 20 point. You're continuing to see a MACD that's still moving upward. You're continuing to see RSI pressure that won't bounce below 70. So you've got a kwacha that's going to continue going down this way. Now, on the global market, volatility has struck once again by tweet. President Trump released a tweet last night basically saying that he's ended all stimulus talks, and that has now that's thrown a whole spanner into the works of trying to get the economy stimulated back again, though his argument is, look, there are parts of this economy that are working correctly. If we continue these stimulus talks, we're just going to keep going up and down onto the market. So on this point, we are seeing that the main concern, obviously coming around, is the stimulus talks coming to an end in America, and also there's going to be the vice president's debate. So those are the two things we're going to watch for. Though the polls are saying favorability is moving towards President Biden, Vice President Biden as a candidate, though likability, not more likability, but more support, which part of the voter base actually supports you for you, that's still leaning towards President Trump. So we've got a race that's up in the air with less than 30 days to go, and I'm expecting much more volatility to get unleashed onto the markets going through this period.
Right, Munyumba, thank you so much for coming through this evening.
Thank you very much, Ewan.